Picture this. You're sitting in a boardroom in Munich 2020. The company around you was worth 24 billion euros just months ago. Your payment processing system handles transactions for millions of people worldwide. You're supposed to be Germany's answer to PayPal. There's just one tiny problem. 1.9 billion euros of your money doesn't exist, never existed, and hasn't existed for years. Welcome to Wirecard, the company that convinced investors, regulators, and an entire nation that they were revolutionizing payments while secretly running one of the most elaborate accounting frauds in European history. This is the story of how a small German payments company fooled everyone for 2 decades, became a 24 billion euro darling of the stock market, and then vanished overnight when someone finally asked the simple question, "Where's the money?" Spoiler alert. Nobody could answer that question. To understand how Wirecard pulled off this spectacular fraud, we need to go back to 1999. Back when the internet was dial-up, Nokia phones had actual buttons, and most people still paid for things with actual cash. A man named Marcus Braun had a vision. Not a revolutionary vision, just a simple one. He wanted to help online businesses process credit card payments. Think of it as digital plumbing, boring essential and potentially very profitable. Wirecard started as exactly what it claimed to be a payment processor. When you bought something online in the early 2000s, there was a decent chance Wirecard handled the transaction behind the scenes. They charged small fees, kept the money flowing, and everyone was happy. Here's where the story gets interesting. While companies like PayPal were grabbing headlines in America, Wirecard was quietly building something similar in Europe. They processed payments for adult websites, gambling sites, and other businesses that traditional banks wouldn't touch. Risky, yes. Profitable, extremely. By 2005, Braun had taken over as CEO. He was an Austrian accountant who spoke softly and wore unremarkable suits. Picture the least likely person to mastermind a 2 billion euro fraud. That was Marcus Braun. But Braun had bigger dreams than just processing payments. He looked at companies like PayPal selling for billions and thought, why not us? The problem was simple mathematics. Wirecard's real business was growing, but not fast enough to justify the valuation Braun wanted, so he decided to get creative with the numbers. Around 2010, something miraculous started happening to Wirecard's business. According to their financial reports, they were experiencing explosive growth in Asia. Not just good growth, absolutely phenomenal growth. Their Asian operations were supposedly processing payments for major retailers, handling massive transaction volumes, and generating profits that would make tech giants jealous. The numbers looked incredible on paper. Investors loved it. Here was a German company cracking the massive Asian market while their competitors struggled. Wirecard's stock price began its steady climb toward the stratosphere. But here's the thing about Asia, it's really far away from Germany. And in the early 2000s, conducting detailed audits of foreign subsidiaries was expensive, time-consuming, and frankly, most auditors didn't want to deal with the hassle. Perfect for a company that needed to show explosive growth, but didn't actually have it. Wirecard began reporting massive revenues from their Asian operations. Money was supposedly flowing through their Singapore-based partners, their Philippine subsidiaries, their Indian joint ventures. The beautiful thing about this strategy was its simplicity. Who's going to fly to Manila to verify that Card Systems Middle East FZ LLC actually processed 500 million euros in payments last quarter? The auditors certainly weren't. Ernst & Young, Wirecard's longtime auditing firm, relied heavily on management representations and third-party confirmations. In layman's terms, they basically asked Wirecard's executives, is this money real? And when Wirecard said yes, they took their word for it. By 2015, Wirecard was reporting that roughly 70% of their revenue came from these mysterious Asian operations. 70%. Of a company supposedly headquartered in Germany. The story was compelling, the growth was impressive, and the stock market rewarded them handsomely. There was just one small detail that should have raised some eyebrows. Nobody could actually verify where all this Asian money was coming from. Success breeds respectability, and Wirecard was becoming very successful indeed. By 2018, they had achieved something remarkable for a German tech company. They were invited to join the DAX 30. The DAX 30 is Germany's premier stock index. Think of it as the German equivalent of the Dow Jones Industrial Average. It includes only the biggest, most established companies in Germany, BMW, Siemens, Deutsche Bank. Getting into the DAX isn't just about size, it's about proving you belong among Germany's corporate elite. Wirecard replaced Commerzbank, a 150-year-old bank. Let that sink in for a moment. A payment processor that barely existed 20 years ago was now considered more valuable and important than one of Germany's oldest financial institutions. The German media celebrated this as a triumph of digital innovation. Finally, Germany had a tech champion that could compete with American giants. Politicians praised Wirecard as proof that Europe could produce world-class fintech companies. Marcus Braun was invited to economic summits. He gave speeches about digital transformation. He met with ministers and regulators who wanted to understand how German innovation was conquering Asian markets. The company's valuation hit 24 billion euros in 2018. To put that in perspective, they were worth more than Deutsche Bank, Germany's largest bank, more than Lufthansa, Germany's flag carrier airline, more than Adidas, the global sportswear giant. But here's what makes this story truly remarkable. While Wirecard was achieving all this success and recognition, journalists and short sellers were starting to ask uncomfortable questions. And the more they dug, the less sense Wirecard's business model made. In 2019, a British journalist named Dan McCrum was having trouble sleeping. McCrum worked for the Financial Times, and he'd been investigating Wirecard for months. The more he looked at their financials, the more confused he became. The numbers just didn't add up. Wirecard claimed to process billions in payments across Asia, but McCrum couldn't find evidence of these massive operations. He traveled to Singapore and the Philippines trying to locate Wirecard's supposed partners. What he found was a handful of small offices and a lot of confused employees who seemed surprised anyone was asking about billion-dollar payment volumes. McCrum published his first major investigation in early 2019. The headline was simple but devastating: The House of Wirecard. His reporting suggested that much of Wirecard's Asian business was fictional, created through a complex web of fake transactions and fabricated partnerships. Wirecard's response was swift and aggressive. They didn't just deny the allegations, they went to war. The company hired expensive lawyers and private investigators. They accused McCrum and the Financial Times of working with short sellers to manipulate their stock price. They suggested the reporting was part of an Anglo-Saxon conspiracy against German companies. German regulators initially sided with Wirecard. BaFin, Germany's financial regulator, was so convinced that McCrum's reporting was market manipulation that they banned short selling of Wirecard stock for 2 months. Think about that. Instead of investigating whether Wirecard was committing fraud, regulators protected them from journalists asking questions. But McCrum kept digging, and other journalists started paying attention. Every new investigation revealed more inconsistencies, more mysterious Asian partners, more transactions that couldn't be verified. The beautiful thing about the truth is that it's remarkably consistent. Lies, on the other hand, require constant maintenance. And by 2019, Wirecard's lies were becoming impossible to maintain. By early 2020, the pressure was becoming unbearable. Regulators were finally starting to ask the questions they should have asked years earlier. Investors were getting nervous, and Wirecard's auditors at Ernst & Young were being forced to do something they'd avoided for years: actually verify the money. In June 2020, Ernst & Young made a simple request. They wanted to confirm that 1.9 billion euros in cash, roughly half of Wirecard's reported assets, actually existed. This money was supposedly held by Wirecard's Asian partners in escrow accounts, ready to be deployed for future business operations. The request was reasonable. If you're auditing a company, you should probably verify that their biggest assets actually exist. It's Auditing 101. Wirecard's management assured everyone this would be simple. The money was held by trustworthy partners in the Philippines. Documentation would be provided shortly. There was absolutely nothing to worry about. Weeks passed, then months. Ernst & Young kept asking for confirmation. Wirecard kept promising it was coming. Finally, in June 2020, the Philippines partners responded. Their message was brief and devastating. "We have no idea what you're talking about. We've never held 1.9 billion euros for Wirecard. We've never held any significant amounts of money for Wirecard. Let me repeat that 1.9 billion euros, half of Wirecard's reported assets, simply did not exist. Had never existed. This wasn't an accounting error or a timing difference. This was money that Wirecard had been claiming as assets for years. Money that justified their massive valuation. Money that investors believed was sitting safely in Asian bank accounts. It was all fiction." What happened next was one of the fastest corporate collapses in modern history. On June 18, 2020, Wirecard admitted they couldn't account for 1.9 billion euros. The company's stock price fell 62% in a single day. By the end of the week, it had lost over 90% of its value. Markus Braun resigned as CEO on Friday, June 19th. By Monday, he was arrested at Munich airport on charges of market manipulation and accounting fraud. The mild-mannered Austrian accountant who had fooled Germany's financial establishment was now facing decades in prison. But the story gets even stranger. Wirecard's chief operating officer, Jan Marsalek, simply vanished. Not figuratively vanished, literally vanished. He was supposed to help locate the missing money, but instead he disappeared completely. Authorities believe he fled to Russia, possibly with the help of intelligence services. Think about that for a moment. The COO of a major German corporation, a man who regularly attended board meetings and gave presentations to investors, turned out to be connected to Russian intelligence and disappeared like a character in a spy novel. Within days of the admission, Wirecard filed for insolvency. A 24 billion euro company was bankrupt, not struggling completely worthless overnight. The ripple effects were immediate and brutal. Thousands of Wirecard employees lost their jobs. The company's payment processing services shut down, disrupting businesses across Europe and Asia. Credit card companies scrambled to find alternative processors for millions of transactions. But perhaps the most shocking revelation was still to come. How long had this been going on? As investigators dug deeper into Wirecard's collapse, a truly staggering picture emerged. This wasn't a recent fraud that got out of hand. This was systematic deception spanning nearly 20 years. Documents revealed that Wirecard had been inflating revenues since at least 2015, possibly earlier. The Asian expansion miracle that impressed investors. Most of it was fabricated. The mysterious partners processing billions in payments. Shell companies designed to create the illusion of business activity. Here's how the fraud worked in practice. Wirecard would create fake sales by moving money in circles. They would send 100 million euros to a partner company who would then send it back as payment for services that never existed. On paper, this looked like 100 million euros in revenue. In reality, it was the same money going in a circle. They used a network of shell companies across Asia to make these circular transactions look legitimate. Money would flow from Wirecard to Company A in Singapore, then to Company B in the Philippines, then to Company C in Dubai, then back to Wirecard as revenue from processing payments. The beautiful thing about this scheme was its international complexity. German auditors had trouble following money trails across multiple countries and legal systems. By the time anyone tried to verify a specific transaction, it had passed through so many entities that the original source was nearly impossible to trace. But maintaining this elaborate fiction required more and more money. Each year, Wirecard needed to show growth, which meant creating larger fake transactions, which required more cash to keep the circles spinning. By 2019, they were borrowing billions from banks to fund these fake transactions. Deutsche Bank, Commerzbank, and other major lenders happily provided loans to what appeared to be a rapidly growing tech company. That borrowed money was then used to create fake revenues, which justified borrowing even more money. It was a Ponzi scheme disguised as a tech company. And like all Ponzi schemes, it could only end one way. The Wirecard scandal sent shockwaves through Germany's financial establishment. This wasn't supposed to happen in a country famous for rigorous auditing and conservative banking. BaFin, the regulator that had banned short selling to protect Wirecard, faced massive criticism. How had they missed a fraud of this scale? Why had they attacked journalists? Instead of investigating the company, the regulator's president resigned in shame. Ernst & Young, Wirecard's auditor for over a decade, faced lawsuits and investigations across multiple countries. Critics asked how professional auditors had failed to detect fictional revenues year after year. The firm paid hundreds of millions in settlements, but maintained they had been deceived along with everyone else. German politicians were forced to answer uncomfortable questions. How had the country's financial oversight failed so spectacularly? Why had regulators been so eager to protect a German tech champion that they ignored obvious red flags? But the human cost was perhaps the most tragic. Thousands of ordinary investors lost their life savings. Many had bought Wirecard stock as part of their retirement planning, trusting that a DAX 30 company was a safe investment. Elderly Germans who had invested in their country's supposed tech success story watched their nest eggs evaporate overnight. Small businesses that relied on Wirecard's payment processing were left scrambling to find alternatives. Some couldn't process credit card payments for weeks, losing customers and revenue through no fault of their own. The scandal also damaged Germany's reputation as a financial center. International investors began asking whether German regulations were strong enough to prevent fraud. Some institutional investors moved money out of German markets entirely. As of 2024, Marcus Braun is serving an 11-year prison sentence for fraud and market manipulation. Jan Marsalek remains missing, believed to be living under Russian protection. Investigators are still trying to trace the billions of dollars that vanished in the collapse. Here's the most incredible part of the Wirecard story. It almost worked. For 20 years, a payment processing company convinced the world they were a tech giant. They fooled investors, regulators, auditors, and politicians. They joined Germany's most prestigious stock index. They were worth more than Deutsche Bank, all while running what was essentially an elaborate accounting trick. The scandal revealed something uncomfortable about modern finance. Nobody really wants to ask the hard questions when a company is making everyone rich. Investors didn't dig too deep because the stock was rising. Auditors didn't push too hard because the fees were good. Regulators didn't investigate too thoroughly because Wirecard was a German success story. But perhaps the most ironic twist is this. While Wirecard was busy faking billions in Asian revenues, real fintech companies like Stripe Square and Adyen were actually building the businesses that Wirecard only pretended to have. They're now worth hundreds of billions and actually process the payments they claim to process. Turns out building a real business is more sustainable than faking one. Who could have predicted that the missing 1.9 billion euros, by the way, was never found? It's still out there somewhere, or more likely it never existed in the first place.